just stared at your phone, seen a headline screaming that the stock market has hit yet another record high, and just felt this intense wave of frustration? Mostly because the cost of your everyday life feels completely, totally out of control. Well, you are definitely not alone, and you are not crazy. Today in this explainer, we're going to unpack the ultimate economic paradox, Wall Street versus Main Street. We're strictly looking at the data to figure out exactly why a booming market can exist right alongside an agonizing cost of living, and why, honestly, those two things are actually completely disconnected.
Okay, let's dive right into this by picturing two people living in the exact same apartment building, but existing on two completely different economic planets. Take Barron. He just got a lovely morning text message from his landlord raising his rent again. He flips his phone over in frustration, right? Meanwhile, 3 floors up, we have Nikki. She sees the morning news about the market hitting a record high, opens her brokerage app, and watches her portfolio jump up by thousands of dollars. We're talking more than Barron makes in an entire year. Same city, same building, same news cycle. So how is this even possible?
Well, here is the crucial takeaway. The stock market is not the economy. I know we hear that phrase a lot on TV, but let's use a mental model that actually makes sense. Think of the stock market as a giant scoreboard hanging over a massive stadium. Your instinct, which is a totally reasonable instinct, by the way, is to assume that the scoreboard is measuring how the entire crowd is doing. But it isn't. It is strictly measuring the performance of a very small number of players down on the field. That scoreboard flashing green, it doesn't mean your seat in the stands just got more comfortable or your ticket got cheaper. Internalizing this scoreboard metaphor is literally step one to making sense of all this madness.
We really have to realize that the market isn't a thermometer reading today's temperature. Actually, scratch that. It's more like an overconfident fortune teller pricing in the year 2030. Think about your present day, your random Tuesday struggles, the crazy price of groceries, your wages, rent. The stock market doesn't care about today at all. It is placing highly confident bets on what a handful of enormous companies are going to earn years from now. So when you feel broke today and the market rips to a brand new high, they aren't even describing the same time period. And this stat brilliantly illustrates why it feels so completely disconnected from your hometown. Just look at this number, 28%. Roughly 28% of the revenue brought in by the companies in the S&P 500 doesn't even come from the United States. It comes from overseas. And for the big tech companies, it's actually over half. That scoreboard you keep anxiously glancing at isn't measuring your local grocery store. It's measuring how well tech companies are selling phones in Europe and shipping data chips across the planet, completely bypassing your local economy in the process. So, accelerating the pace to match this Wall Street party, let's talk about the Magnificent Seven. These are the tech companies driving a record-breaking market concentration that we honestly haven't seen since the dot-com bubble. You'd think a record high means 500 companies are all rising together, right? Not exactly. Just 7 tech giants make up a staggering 32% of the entire index. Widen that to the top 10, and they command 40%, meaning the remaining 490 companies are all squished into that leftover 60% slice. The truth is, this massive party is being held in a much smaller room than you think. So what does that actually mean for an everyday investor? Well, if you drop $10,000 into a normal index fund, you aren't buying 500 equal pieces of the American economy. Because the market is so top-heavy, you are effectively dumping $3,200 into just those 7 giants at the top and handing out literal pennies to the hundreds of companies at the bottom. You are essentially buying 7 giant bets, standing on each other's shoulders in a trench coat with the word diversification quickly scribbled on the front. Now, slowing down to face reality for a second, ask yourself who collects the cash when that scoreboard flashes green. Because this party is happening inside houses most people were never even given the keys to. Let's break down stock ownership by wealth. The top 10% of households own roughly 90% of all the stock that exists. The middle 40% hold about 9%. And the bottom half of the entire country, they own a combined 1%. So when a TV anchor sounds super excited about a record high, you gotta remember those gains are landing almost entirely in the accounts of people who are already wealthy. To put that into perspective, think about the same market, the exact same day, and the exact same percentage gain. But look at the difference in absolute dollars. The median American retirement account is sitting at about $44,000. Amongst your 20% market gain yields them roughly $8,800. While the middle-class worker gets a mildly nice number on the screen, a wealthy household with a $2 million portfolio gains $400,000 from the exact same market move. The wealthy out-earn a decade of a normal salary without lifting a single finger. And that right there was always the story of Nikki and Barron. Let's move to the market's hidden engines to see how this builds such wild momentum. It starts with what I call the Roomba autopilot.
the system that blindly buys stocks every single payday, regardless of how the economy actually feels. Step 1, your paycheck hits instantly. Step 2, your 401k contribution is pulled. Step 3, that money goes straight into index funds that buy stocks with absolutely zero opinions about whether the market is expensive or cheap. And finally, this automatic behavior creates a mountain of relentless upward market pressure that just never stops, even if the economic building is actively on fire.
Engine number 2 is corporations basically voting for themselves with their own wallets. We are talking about companies spending a record $1 trillion in a single year on stock buybacks. When a company buys its own stock off the open market, there are suddenly fewer slices of the pie left for everyone else. Just by simple math, each remaining slice becomes a little more valuable. This mechanically shrinks the pie and drives prices up. And guess what? This has absolutely nothing to do with whether regular people are doing okay. Meanwhile, shifting back to Main Street for a minute, consumer sentiment is currently lower than it was during the 2008 financial crisis. Why? Because cumulative inflation has permanently eaten a quarter of our purchasing power since 2020. Notice this massive 25%. Prices are up roughly a quarter in just a few short years. And unless your paycheck grew to match it, which let's be real, for many it hasn't, the money in your pocket permanently buys a quarter less than it used to. People don't feel bad because they're ungrateful. They feel bad because they are looking at the actual receipts of their lives. So when the news cheerfully reports a booming economy, you absolutely aren't wrong for feeling gaslit, especially when your lived reality is that the monthly payment on a typical house has essentially doubled since 2020. Let's look at the brutal reality of the housing scoreboard. Back in the 1990s, a median home cost about 3 times the average household income. Today, it is roughly 5 times the income. Pushing the typical age of a first-time homebuyer all the way up to 40, you are quite literally reading a completely different scoreboard than the one they show on TV. Now, to get the full picture and be completely fair here, we have to look at both the bull and bear cases. On the bull side, these giant companies genuinely are printing absurd profits. Their profit margins are near the highest in recorded history because they're acting as the digital plumbing for the entire planet. But looking at the bear side, historical metrics are screaming that stocks are incredibly expensive. Take the CAPE ratio, which compares current stock prices to long-term corporate earnings. It is sitting at its second highest reading in 145 years. The only time it was ever higher was the absolute peak of the dot-com bubble. So, pulling this all together to explain our original paradox, keep this incredibly powerful summary in mind the next time you see a flashy financial headline. The market measures the future, not your right now. It measures giants, not 500. Owners, not you. The stock market hitting a record high was never a statement about your rent, your raise, or your grocery bill. So what's the game plan? What should you actually take away from this explainer? Well, first off, record highs are just a boring default state of a growing market. We've averaged about 17 of them a year since 1950, so don't panic and sell. Second, consider diversifying a bit more broadly across all 500 companies or even internationally, so you aren't just betting the house on a handful of tech giants. And finally, start viewing investing as a mechanical game that you enter over time, not a superhero coming to rescue you. Your job isn't to resent the scoreboard, but to slowly and quite unglamorously buy your own way onto the field. To wrap things up, I want to leave you with this final kind of perspective-shifting question to ponder for your own financial journey. If the record high was never measuring you in the first place, what would it actually take to get you into the game it is measuring? Stop waiting for a magic number on a screen to come rescue you. Understand the mechanics, ignore the daily noise, and figure out how to slowly buy your own way onto the field, one paycheck at a time. Thanks so much for joining me for this explainer.